So the Federal Reserve just releasing its second round of tests on the health of the nation's largest banks. This report showing what specific banks will be eligible to give money back to their shareholders in the form of dividends and buybacks. Adam Shapiro's got it. Go, Adam.
They all pass, essentially. Everyone passes. There are adjustments. American Express had to adjust, but no problems there. Capital One Financial, investors there, you're going to want to pay attention because in 6 months, they have to make some changes or the Fed may object to them paying dividends. But the big headline right now is everyone invested in financial stocks and some of these big banks get ready for some big dividends because a senior Federal Reserve official told us that the banks as an aggregate are expected to pay out 100% of their net revenue in dividends and share buybacks this year, as compared to last year when it was 65%. So let's get into the numbers because, again, everybody essentially passed, no objections, but Capital One. Here's what the Fed said about Capital One. I'm going to read you the quote. We made a full screen for you. The Federal Reserve did not object to the capital plan of Capital One Financial Corporation, but is requiring the firm to submit a new capital plan within 6 months that addresses identified weaknesses in its capital planning process. So they've got 6 months to address those issues, and at that point, the Fed could either object to going forward with dividend payments or not. Now, the other issue that's going on here is Capital One did come in with an adjusted Tier 1 common equity ratio, 5.9%. Remember, the metric here, you got to have 4.5% or better. So Capital One, they're fine. You're going to get a dividend, perhaps, but in 6 months they have to address this again. Now let's look at the big banks, how everyone scored. Again, I pointed out that American Express, after the stress test results last week, got the one shot to adjust, and they did. Their adjusted common equity Tier 1 capital ratio, 5.3%. That's above the 4.5%. Bank of America, 6.8%. Warren Buffett's a happy man right now, as we talked about in the last hour. Citigroup, 8.0%. Goldman Sachs, 6.0%. J.P. Morgan, 6.9%. Morgan Stanley, 7.9%. Wells Fargo, 7.4%. So again, this is really no objections, and the first time there haven't been any objections from the Fed or its staff to the capital plans from the big banks. Last year, of course, there were objections to some of them. But I want to read to you why they're taking issue with Capital One, and this is from the report. Quote, notable weaknesses were identified in the oversight and execution of the firm's capital planning practices, which undermine the reliability of the firm's forward-looking assessments of its capital adequacy under stress. Specifically, the firm's capital plan did not appropriately take into account the potential impact of the risks in one of its most material businesses. They won't tell us what that business is. So the bottom line, everybody passes. The other headline, expect some big dividends because they're going to be paying out as an aggregate, 100% net revenue, whereas last year it was 65%. Cha-ching. Back to you.
There you go. Adam Shapiro, thank you.